Between 2020 and 2022, the world's major central banks bought $7.7 trillion of government debt. They called it stabilization. They called it support. They called it whatever the moment required. And now, just 4 years later, they are quietly selling it back. $5 trillion of unwinding. 65% of everything they bought during the pandemic. Reversed, without a single press conference explaining why it matters to you. Here's the question almost no one is asking. If central banks were the biggest buyers of government debt for 15 years, and they are now sellers, then who exactly is buying it now? And what happens when nobody wants to? September 2008, Lehman Brothers collapses, credit markets seize. The financial system stops breathing, and the world's central banks face a choice they were never designed to make. The traditional monetary tool, cutting interest rates, was already exhausted. Rates had hit zero. There was nothing left to cut. So the Federal Reserve invented something new. They would create money digitally and use it to buy government bonds and mortgage securities directly from the market. The idea was simple. By becoming a massive buyer, they would drive bond prices up. And when bond prices go up, the interest rates attached to them go down. Lower rates would mean cheaper mortgages, cheaper business loans, and a way to push money back into a frozen economy. They called it quantitative easing, the polite term for the most radical monetary experiment in modern history. In 2008, the Federal Reserve's balance sheet was about $900 billion. By 2014, after 3 rounds of quantitative easing, it was over $4 trillion. The Bank of England did the same. The European Central Bank followed a few years later. The Bank of Japan, which had actually pioneered the technique back in 2001, kept going on a scale that made everyone else look conservative. And then came 2020. When the pandemic hit, central banks did not hesitate. They opened the spigots wider than at any point in history. The 4 largest central banks, the Fed, the European Central Bank, the Bank of England, and the Bank of Japan, collectively bought $7.7 trillion of assets in 18 months. To put that in perspective, that is roughly the entire gross domestic product of Japan and Germany combined. By 2022, the Federal Reserve alone owned almost $9 trillion in bonds. The European Central Bank held nearly 9 trillion euros. The Bank of Japan owned more than half of all Japanese government debt in existence. Central banks had become, by far, the largest creditors in the global financial system. They were no longer regulators of the bond market. They were the bond market. And then, just as quietly as it began, it started to reverse. Here is how it actually works. Central banks own trillions of dollars of government bonds. Those bonds have expiration dates. When a bond matures, the government has to pay back the central bank that owns it. Under quantitative easing, the central bank would simply use that money to buy a brand new bond. The cycle continued. The balance sheet stayed huge. Under quantitative tightening, the central bank lets the bond mature and does not replace it. The money flows back. The balance sheet shrinks. And critically, the government still needs to borrow that money, which means it has to issue a new bond to somebody else. This is the part that almost no one is talking about. Between 2008 and 2022, governments could borrow at historically low interest rates because their biggest customer was the very institution that sets interest rates. The central bank was both the lender and the rulemaker. Borrowing costs were artificially suppressed for 15 straight years. Now that buyer's gone. The new buyers are private investors, pension funds, insurance companies, hedge funds, foreign governments. And private investors do not care about monetary policy. They care about return. They want to be paid more for the risk they are taking. So when the central bank steps back and private money steps in, yields go up, always, without exception. Look at what has already happened. In 2020, the 10-year U.S. Treasury yielded less than 1%. By 2024, it was over 4%. That is not just a number on a screen. That is the foundation of every loan, every mortgage, every corporate bond, every business expansion, every government budget on the planet. And here's the part that should stop you cold. The Federal Reserve actually ended its quantitative tightening program in December 2025. The European Central Bank, the Bank of England, and the Bank of Japan are still going. They are projected to drain another $1.2 trillion out of the global bond market in 2026 alone. Combined, the four largest central banks will have unwound roughly $5 trillion of pandemic-era bond buying by the end of this year, 65% of the entire experiment. Reversed, and nobody asked you whether you wanted that, because the price of those bonds determines almost everything else. The yield on the 10-year U.S. Treasury is the single most important number in global finance. It is not just a measure of what the government pays to borrow. It is the benchmark from which almost every other interest rate on the planet is calculated. Mortgages, car loans, credit cards, corporate bonds, student loans, even the rates that emerging market governments pay to borrow in dollars. When the Treasury yield goes up, all of those rates follow. And right now, the Treasury yield is being pushed up by something almost no commentator is naming directly. The fact that the institution that bought trillions of those bonds for 15 years is no longer in the market. This is why mortgage rates in the United States are still hovering near 7%. It is why housing affordability has hit a multi-decade low. It is why small business loans have become almost impossible for first-time owners. The cheap money era did not end because central bankers decided people had it too easy. It ended because they ran out of room to keep buying. But the deeper consequence is happening at the level of governments themselves. The U.S. national debt has crossed $35 trillion. The United Kingdom's debt to GDP is the highest it has been since the early 1960s. Japan's government debt sits at over 2.5 times its annual economic output, the highest of any developed economy in history. And France just had a political crisis triggered, in part, by the inability of its government to agree on spending cuts to satisfy bond markets. All of these governments built their debt, assuming central banks would always be there to absorb new issuance at suppressed interest rates. That assumption is now broken. Here is where it gets dangerous. When private investors price government debt instead of central banks, they can lose confidence very quickly. We saw a preview of this in September 2022, when the United Kingdom proposed unfunded tax cuts. The bond market revolted in 48 hours. Pension funds nearly collapsed. The Bank of England had to perform an emergency intervention. The Prime Minister was out of office within weeks. That episode lasted less than a month. Imagine what happens when the same dynamic plays out across every major economy at once, with no central bank willing to step back in. There's a phrase that bond traders have started using quietly. They call it the buyer of last resort problem. For 15 years, that buyer was the central bank. There was always someone who would step in if private markets refused to pay the price the government wanted. That guarantee made everything in modern finance possible. Cheap mortgages, booming stock markets, massive government spending without a debt crisis. The buyer's gone, and nobody has explained who is supposed to replace them. That is the polite version. Here's the version they are not saying out loud. Central banks discovered, painfully, that the experiment had a ceiling. The longer they suppressed interest rates, the more inflation eventually broke through. The more bonds they owned, the more politically dangerous it became to admit that monetary policy and government fiscal policy had effectively merged into a single operation. The more they expanded their balance sheets, the harder it would be to ever shrink them back without triggering a crisis. So they are shrinking now, quietly, cautiously, hoping that nobody notices the bigger story underneath. And the bigger story is this: the era of the everything bubble was not powered by genius investors or brilliant policy or technological miracles. It was powered by a 15-year program in which the world's central banks were the largest, most reliable, most price-insensitive buyers of government debt in financial history. That program is over, and the consequence is not theoretical. It is the rate on your mortgage. It is the cost of borrowing for the business you work at. It is the interest payments your government now has to find money for, money that, in the United States, already exceeds what is spent on national defense. It is the growing fragility of every developed economy that built itself on the assumption that money would stay cheap forever. Central banks bought trillions of dollars of debt to save the global economy. Now they are selling it back. They will not call it a failure. They will call it normalization. They will call it discipline. They will call it whatever the moment requires. But the question that matters has not changed. If the buyer of last resort is no longer buying, who is? And what happens the first time nobody answers the call? If this changed how you read the financial news, subscribe to Behind Economics. Every week we go where the money goes. And right now, the money is being quietly pulled away from the system that depended on it.